Let's get to our Wrap the Week segment, focusing on how the market has evolved from last Friday to this Friday. Before we get there, let's update on a survey question we asked. It's actually really relevant to a take a step back sort of day, because it's asking which of these four buckets performs the best through the end of the second quarter. So looking forward way out, 4 months out, going to the end of June. Large cap growth, large cap value, small cap growth, small cap value. What I am not surprised at is that 60% of you voted for one of the two small cap answers, small cap growth or small cap value. 40% of you picked one of the large cap segments. The most respondents with 37% was small cap growth. There's a number of different ways you can sort of look at that, but IWO is usually the way that I would do that. So there are ETFs that track different ones. There are S&P 600 ETFs as well, but the Russell 2000 growth is IWO. And what you can see here is, something that's had a pretty solid trend up until about a month ago. And from then you've had this pullback. And the question, as we saw today, what is this? Is this a pullback within a much longer term uptrend? Is this the first of multiple legs down? And either way, what you see here, it's a little hard to see the candle here, but that's a little hammer candle there, where the open and the close are at very close to one another and at the highs of the day, and you have a long lower shadow. Think of it as hammering out a bottom, represents some short-term strength. But we're talking more about the long-term trend. And I agree with the idea that small over large, I think that continues to work. Growth over value is an interesting one because small cap value, if you look at IWN, that's been one of the better places. That's where the relative strength has been. If I had to pick one, I would probably pick small cap value, because this is going to be things like energy stocks and some financials and others that have really shown some strength. We'll have to see. The question is, how much of a pullback, how much of a digestion period, a correction period do we have before we resume the uptrend? Going to our weekly wrap here, let's just start with the chart of the S&P 500. What the chart tells you today, what today's action tells you is, Jim Cramer earlier this week did his 5 stages of I'm trying to think what he called it, 5 stages of dealing with the bear market. I'm paraphrasing, it was something like that. But the 5 stages of the bear market, the first step is disbelief. And I would argue we're still there, because most people, the fact that the stocks do what they did today tells you that people are not believing that a bear market phase is upon us. And again, whether it's a short-term tactical bear, whether it's a corrective period of a couple weeks to a month, that's still sort of a bear market process that we have to get through. We're still in the disbelief phase. The idea that some of these stocks that have had incredible runs have pulled back just about enough. We can ride them now the next leg higher, and we continue and continue and continue. There are later stages where you get to, acceptance, which is the final stage, and it's different parts of it where, you have to deal with, you acknowledge the fact that the market's going lower. You get really despondent thinking, oh my gosh, how low is it actually going to go? The very end of it is acceptance and just sort of, dealing with the fact that it may never go up again. And that's when bear markets tend to end. So again, I still feel like even if there's a short-term correction that we're in, a day like today feels a little more like a dead cat bounce, which is a horrible way of describing a market that overall is in a bearish phase. But you get these quick snapbacks to the upside that will suck some people in because it feels like everything's better again. But when you look back, nothing much has changed from yesterday to today in terms of the overall environment. I still think there, a lot of stocks need to come down further to alleviate the euphoria that we've had up until today. And that's why I would expect for the downside. Having said that, the S&P closed below its 50-day moving average yesterday. On Thursday's session, it closed back above it. So if you're looking for follow through, looking for an indication going into the weekend that we have a lot more downside, I'm not seeing that as much. I'm seeing more hammer candles. I'm seeing short-term, bounces, which argue that that the next couple days going into the beginning of next week probably going to be a little more of a bounce. But overall, the trend remains negative. How you figure out when the trend is not down anymore, it's a couple things, but most importantly, look at the highs and the lows. We are potentially establishing, it's all about where we're at relative to 3,700. That's the January low on that medium-term time frame. That's where I'd be looking. In the short term, are we able to put in some sort of higher low going into next week? Do we break above a trend line using the previous highs? That would tell me, okay, I guess that was it. This is just a short-term pullback. and we resume higher. I think that's unlikely, but it's certainly possible. And that's what would tell you that the bearish thesis is incorrect. As always, you always have your base case, you have what you're planning on, and then you look at what alternate scenarios might look like, and be mentally prepared for those to happen at any point, because they certainly can. Now, wrapping the week basically means let's look at the last 5 trading days and see how things have evolved. So if we start the clock last Friday and just look at the percent moves, sorry, I ran out of time to label all these, but I can give you the last couple labels so you know it. The S&P 500 here in the middle ended up closing the week up about 0.4% from last Friday. So that's not a huge move. And again, a lot of that gain came today when you had the nice bounce higher. As of yesterday, we were down about 1% for the week. So recovered a little bit. What underperformed stocks? Emerging markets up 0.25%. Small caps actually down 0.3%. Gold and the NASDAQ 100 both down around 1.7%. The weakest of all bonds down almost 3%. That's using the TLT as sort of a proxy for bond prices. What outperformed stocks? The dollar actually finished a little bit stronger and had a pretty decent week. And this rotation from weaker dollar to stronger dollar is certainly a different vibe than we've had for quite a while. The dollar index closed up about 1%, and that's using the UUP, by the way. What else outperformed stocks? 2 key assets: crude oil, which was the best of the bunch, up 7.6%. Bitcoin finished up 6.5%, and again, decent week overall for those two. Now you can tell, obviously, energy stocks have been the juice. That's been the strength this week. And even on days when everything else was down, energy managed to be up. Even this morning when things were kind of down, you saw energy was still up, and then everything sort of caught back up and reverted back higher. So those charts of energy stocks remain pretty positive. And not to jump around too much, but when I'm looking at the top 10 ranked scooter names, I'm seeing some media entertainment names. I'm seeing energy stocks. I'm seeing, Marathon. I'm seeing XCC, Devon Energy, FANG, Occidental. Half the top 10 are all energy stocks, and that tells you about this move higher in those spaces. Yesterday, if I remember right, Ari Wald showed the chart of the high beta versus low vol, and that's really speaking to the strength of that energy trade. Continuing on here, let's go to the Mindful Investor Live chart list. Before we get there, the S&P up just under 2%. Again, we're sort of processing the closing ticks here as we record. Mid caps and small caps had a really strong Friday, finishing stronger. The VIX back below 25. Bonds essentially flat, and 10-year yields increased quite a bit, but settled back down. Earlier in the day, it was above 1.6%, closed around 1.55 or so. As a yield on the 10-year. Gold and silver flat, silver down a little bit. And cryptocurrencies really came on strong in the afternoon. They were down earlier in the day and really reverted higher, although by the end, you can see by the top 10 that we follow, pretty much a mixed bag, but Bitcoin re-approaching that 50,000 level. The Mindful Investor Live chart list, if you've not been on a Friday show before, go to my homepage on StockCharts, which is click on the articles tab, go to the Mindful Investor at the very top. You'll see a link to this chart list. You're welcome to take it, use it however you like. The first is our market trend model. We update this every Friday as of the close. I was wondering if we would actually close above the 5-week exponential moving average. It looks like just barely we did not. So I'll have to say that the short-term model remains bearish, although it's really, really close. The medium-term model remains bearish as well, and the long-term model remains bullish. So what this tells you after 2 weeks ago, last Friday is when we turned bearish on those two. It's about what the market feels like right now. Short-term, the tactical side, bearish. Medium-term, bearish as well. And that's when I tell you, I think we have more to do. That's part of that is looking at that medium-term model and seeing that it's remaining negative. The long-term model remains bullish, and that feels about right. This really only turns negative during a really disruptive phase. The last negative signal was there in late February, early March is when it actually turned negative, mid-March, which is basically recognizing a severe downdraft. We're nowhere near that yet. So it hasn't triggered. So long-term bullish, medium-term, short-term bearish is about how the market feels looking at the individual stock charts. The S&P daily chart we talked about bouncing back above the 50-day does not surprise me, because we don't break through something like that after having not broken through it for months and months, and then just continue plowing on. Usually get a nice rebound on a day like today, and that makes a lot of technical sense if you're more negative in the short term, which I am. Where we're not seeing negative patterns are with the cumulative advanced decline lines, and it reminds me by conversations with Ari, with Jonathan Krinsky, which were this week, which were really more long-term constructive, thinking about the long-term bullish scenario and seeing a short-term pullback as an opportunity to add to longer-term upside for stocks that have become very overheated. And I get that argument in a great deal. And I think one of the charts that we looked at was the cumulative advanced decline lines in both cases. And you can see that they're just consistently strong. Even though the S&P itself is breaking its 50-day, these cumulative advanced decline lines are not touching their 50-day moving average yet. They're also not hitting their January swing low yet. You need to see those break to indicate more of a broader distribution, and we're not seeing it yet. In terms of new highs, you're still getting a decent number of new highs. This isn't updated yet for today, but through the course of the week, you had 25 to 50 S&P names every day making a new 52-week high. That's not bad. That's actually still pretty good. Looking at the percent above the 50-day, this is a concerning one. It actually got below 50% on Thursday. This isn't updated yet for today. I'm assuming it'll bounce up a bit today off of there, but this indicator only goes below 50% during short-term corrective patterns. The percent of stocks above their 200 days still around 80%, and that's probably going to hold on today's close. You wait for that to get below 50% to get really negative about the overall market environment. Not there yet. Sentiment, we won't waste time on. It's all come down. A 40% swing in the last 2 weeks on active investment managers going more to the defensive side of the ledger, or taking their foot off the accelerator, or starting to tap the brakes is how I would describe that. It's a pretty significant switch, and shows you that money managers are going a little less risk on, not quite full risk off yet, but taking some bets off the table. This chart here, and this is all that we're going to have time for on the Wrap the Week segment, but I just wanted to point out this chart, I think on its own represents where we're at right now. The cap-weighted consumer discretionary versus consumer staples rolling over in a big way. The equal-weighted, not really at all. And this is still in a very clear uptrend. The top one, the cap-weighted one, arguably in a flat trend, if not now in a negative trend, having broken down through some swing lows over the last month or two. This is Amazon breaking down, which is a huge weight in the numerator. And when that happens, it's doing it. So when you overweight the mega caps, it looks a lot worse than it probably is. When you take an equal weighted version, you can see it's still offense over defense. There just aren't a lot of charts in consumer staples that look great. Like tobacco stocks always come to mind recently as a fairly decent set of something like MO, but overall, consumer discretionary still over consumer staples, broadly speaking. A lot more charts in that Mindful Investor chart list. Go ahead and download it. You can, if you have a StockCharts account, take a look. And if you have questions, let us know. We'll answer them maybe in a future mailbag segment.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.